So last time we were talking about defining memberships, and in that explanation I mentioned that in most cases we'll get rid of the 1 month membership, possibly the 3 month membership, and the paid in full membership. And the reasoning behind that is something that we call the receivables base. A receivables-based financial structure is what a health club needs today to survive. In other words, a club doesn't really want to collect a lot of cash up front and instead should focus on collecting their memberships on monthly dues. In our philosophy, a club is not defensible if it collects more than 10% cash at point of sale. There are a few reasons for this. Number one, as the monthly receivables base gets built up to a point where it covers the majority of the club's overhead, the amount of new cash needed each month decreases. This makes the club more stable in the slower times of the year. It also takes the pressure off the sales system so that they don't have to high pressure prospects to become new members. In the old days, for example, we used to have a paid in full membership for $4.99, but if they signed up today, they could get it for $3.99 because most clubs were so heavily dependent on cash memberships. We constantly needed to have a sale and drop close to get the paid in full membership up front. Say you have two clubs that are exact same size. Each of them have an equal $40,000 per month overhead. Club 1 only has a receivables base of $10,000 per month. So they have to bring in $30,000 per month each and every month just to break even. Club number 2 across town also has an overhead of $40,000 per month, but they have a receivables base of $32,000 per month. So they only have to bring in $8,000 per month to hit their break-even point. This club obviously is more stable and less stressful than that club. Right now I have a client who has a functional / group training club. He also actually has an overhead of $40,000 per month, but his receivables base is $57,000. So right at the beginning of the month, before he sells one new membership, he's already profiting $17,000. This obviously is a lot less stressful than even that, and it changes your life completely from this club. After a club passes the 2-year mark, it gets tougher to maintain the excitement of being a new club. Measures must be implemented to keep the freshness of the club in order to continue to attract new members, but also to keep the retention rate high. Our research shows that a club must be revamped every 4 years to keep it defensible against new competition that might move into the area. If a club's receivables base is high, there's a greater chance for profitability, so the club has the ability to create an accrual account for future capital expenditures. Now for the kicker. If you have a personal training club and that club is built on the reputation of the owner / trainer, and that club only sells training in packages instead of in memberships, that club is not worth anything. You can't sell it, and the bank won't loan you money against it. A club with a good receivables base looks stable from a bank's point of view if a loan is needed. The bank looks at the receivables base as an asset. Now, the term receivables base isn't just the fact that you're billing your members monthly for their memberships. In order for a bank or future buyer to project their business into the future, the membership must be on a contract for a specified period of time. If the membership is month to month, or if it has a contract with a cancellation clause in it, then the membership is not considered a receivables-based membership and it doesn't have any value. So if a club has a receivables base of $50,000 a month, that's worth something to the bank, and they will put a value on it as an asset and they'll loan you money against it. And if I'm doing a formal valuation on a club for a potential sale, I use a number of different calculations to value the club. But the receivables base is probably the most valuable asset that the club has. So if you have a traditional club, the goal is to have 70% of the overhead covered by the receivables base by the end of the second year. If you're a hybrid personal training / functional group club, then pretty much all of your memberships are going to be receivables-based memberships. If you're selling mostly training packages now or still selling a lot of cash up front, I do recommend that you gradually transition into a receivables-based membership system. Just be careful that you don't make the adjustment too quickly so that the club becomes vulnerable because you need a certain amount of cash to break even. Do a goal setting session where you can calculate how much cash per month you can sacrifice and set up a percentage goal of each type of membership that you can sell in order to grow the receivables base while keeping the club safe.